The equity multiple is used in almost all commercial real estate investment materials, and similar to the IRR, this metric can be a really helpful tool, but it needs to be used correctly in order to be relevant. And just like the IRR, two deals producing the same equity multiple values can have very different business plans and overall return profiles, but when used in conjunction with a few other key metrics, the equity multiple can help you paint a much clearer picture of a deal and the potential profitability of an acquisition or development. So to give you some more clarity on this metric outside of the standard textbook definition, in this video we'll walk through what the equity multiple actually represents, the practical applications of this figure within commercial real estate, and some key things to look out for when relying on this metric to help tighten up your underwriting and value commercial deals. So in its simplest form, the equity multiple represents the total cash flow distributed on a given investment over time, divided by the total equity contributions throughout the life of the deal. This means that if you invest $100,000 into a project and you receive $250,000 back in total distributions from the time that you made that initial investment in the property, this would represent a 2.5x equity multiple on your initial equity investment. And the first thing to note about the equity multiple is that because this measures the total multiple on invested capital over the entire life of a deal, this metric is really only helpful in the context of other return metrics. So for example, you might invest in a covered land deal that produces just enough cash flow each year to break even over 5 years, buying the land for $1 million in cash and then selling that land for $2.5 million at the end of 5 years, which would result in a 2.5x equity multiple. However, you would also generate that same 2.5x equity multiple on a $1 million investment in an existing operational asset producing $70,000 per year in cash flow and then selling that deal and generating just $1.8 million in net proceeds at the end of 10 years, which is obviously a very different business plan and will attract a very different type of investor. This is why context is so important when referring to this metric, since even though the equity multiples on these deals are identical, on the first deal, your IRR ends up being 20% and your cash on cash is going to end up being 0, while on the second deal, your IRR drops to just 11.6%, but your average cash on cash jumps to 7% during the hold. And even though these investments are both projected to more than double your money, the first deal might be a way better fit for you if you're looking to hit a home run with a big payout at sale and you're not looking to generate income from the investment, but the second deal might be a significantly better option if you're looking primarily for cash flow and you want your capital out in the market for an extended period of time. And while this metric tends to be most useful in the context of other return metrics, this also goes both ways, which leads me to the next important point about the equity multiple, which is that one of the biggest benefits of using this metric within an investment analysis is using this as a benchmark for the internal rate of return, or IRR, on a deal. Since the IRR is generally thought of as the all-in annualized time-weighted return on equity invested, this is usually prioritized in investment materials and acts as the metric that many partnership structures will use to evaluate sponsor performance and calculate promoted interest. However, because the IRR of a project tends to play such a big role in when and how much private equity firms and individual sponsors get paid, the cash flows on a deal can often be manipulated to make this figure as high as possible, both within investor offering materials and at the end of a project, which can make the equity multiple a really helpful additional tool to evaluate a deal and make sure that this isn't the case. Unlike the cash on cash, which only measures cash flow from operations and doesn't take into account cash flow from refinancing or the sale of a property, just like the IRR, the equity multiple factors in all cash flows on a deal and can give you a much clearer picture of the overall profitability of a project in whole dollar terms. And what this tangibly means in practice is that if you see a 17% or a 20% or a 25% IRR are being advertised, especially in short-term hold scenarios, you can use the equity multiple as a more honest barometer for how profitable a deal might actually be, aside from just the percentage growth that's expected on the investment. And similar to the equity multiple, you can have two substantially different deals that produce identical IRR values, but the equity multiple can be used to get a more holistic picture of an investment and the cash you can expect to generate for every dollar that you put in. So for example, if you're analyzing two deals, each projected to generate a 30% IRR, just by taking a look at the internal rate of return, you might see these investments as equally as profitable. However, if I were to tell you that in the first scenario, you'd invest $1 million up front and then sell the property a year later for $1.3 million, and in scenario 2, you'd invest that same $1 million up front, but hold on to the property for 5 years, generating $100,000 in cash flow each year, and then you'd sell the property for $2.8 million at the end of year 5, these 30% IRR figures start to look substantially different. And to quantify this difference, this is where the equity multiple comes into play, with a 1.3x equity multiple in scenario number 1 and a 3.3x equity multiple in scenario 2, providing significantly more context into each deal and the total dollar amount you can expect to generate for every $1 invested in each deal up front. This is why you'll sometimes see sophisticated institutional investors not only requiring a sponsor to hit an IRR-based preferred return, but also an equity multiple-based preferred return as well, to make sure that the investor isn't just manipulating the IRR solely through a quick refinance or sale of the property, but they're actually earning a worthwhile multiple on that invested capital before promoted interest starts to be paid out. Now, if 2022 and 2023 have taught us anything, it's that real estate deals don't always go as planned. And the last thing I want to point out about the equity multiple metric is that the equity basis portion within this formula can change over time based on capital contributions. So for example, if you were to invest that same $1 million into a deal up front, but then in the first year of your ownership period, you end up needing to put an additional $200,000 of equity into the deal, that equity basis would now increase on the project from $1 million to $1.2 million. And this means that if you turn around and sell the property for $1.5 million at the end of year 2, the equity multiple on the deal would now be calculated by taking that $1.5 million distribution and dividing that not by that initial $1 million equity investment, but instead that new $1.2 million equity basis, resulting in a 1.25x equity multiple, rather than taking the $1.5 million distribution minus the $200,000 equity investment made in year 1, and then dividing that by the initial $1 million equity amount, which would instead result in a 1.3x equity multiple. Again, this is where the equity multiple term starts to get really literal, which is why this metric is also sometimes referred to as the multiple on invested capital, or MOIC for short, with every dollar that you put into a deal increasing the denominator of this calculation, and every dollar you receive from a deal increasing the numerator of this calculation. Now, obviously, this doesn't always come into play on all deals, and ideally, unless you're investing in a ground-up development project, you won't need to make any additional unplanned capital contributions after the initial investment period. But if you are required to contribute additional cash into a deal after your upfront contribution is made, just know that this is going to increase your equity basis rather than reducing your total distributions. Ultimately, the equity multiple is one of the most important metrics tracked within a real estate investment analysis, especially when looking at deals with a short-term hold horizon. So whether you're evaluating your own investment opportunities or just investing passively, and you want to take a more holistic approach when analyzing deals, taking a look at the equity multiple alongside metrics like the IRR and the cash on cash is going to give you a much more complete picture of the overall projected performance of a deal. And if you want to learn more about equity multiples, IRRs, cash-on-cash returns, and other commonly used investment metrics within the real estate industry, and then how to apply these within a real estate investment analysis directly, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you also get access to the Breaking a CRE Analyst Certification Exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more deep dive content on specific return metrics on this channel, make sure to hit the like button and let me know. And if there are any other metrics you'd like to see covered in more detail in the future, make sure to leave those in the comments and let me know. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.